For those of you new to direct indexing, this could come as a shock, but it's not always best to direct index into an ETF. However, what do you do if you're trying to direct index into stocks? You kind of have two choices. Either go with a super high entry fee, such as $100,000 or $500,000 or $1 million, or you do it individually. I think we both can agree, no one wants to sit and manually tax loss harvest or direct index, stocks at an individual level, but you also want to make sure that you're not hitting a limit or a bottom in terms of the minimum amount you need to invest in order to make a return. That's what we're going to talk about today with Frec. And Frec is a new product I found. It's been on the market for a little while, and we're going to go over it today and see if it makes sense for you. Before we get into that, make sure you like, subscribe, and comment if you like this video. And don't forget to share it as well. Okay, so let's first talk about what is direct indexing. So direct indexing is a personalized approach to investing, which allows you to own an individual stocks within an index that offers tax optimization and customization that mutual funds or ETFs can't match. So, you're used to buying an index fund like an SPY or a QQQ that has all these different stocks in it. You pay an expense ratio or an ER of maybe 25 basis points or 50 basis points or whatever that is, and that's a managed fund. That's an actively managed fund. But a lot of people want to own individual names without paying the expense ratio while also getting the benefit of direct indexing. So that's number one. And I said a minute ago, number two is the traditional barrier of having to work inside an environment where there may be a really high minimum to get in. So that could be a hedge fund, that could be a private investment, or that could be at a traditional financial institution like a JP Morgan or a Vanguard that does offer direct indexing, but the barrier to entry is so high. As I move over here, we're actually going to jump right into Frec and show you the homepage. We're going to walk through a little bit of a demo of what I've went through and seen. And to be fair warning, this is not sponsored by Frec. I have not set up an account yet with Frec. I'm still doing my due diligence, but I hope that you'll be able to take advantage of the work I've done to make you a better investor. So Frec here on the homepage, frec.com, you'll see they talk about it right now, indexed investing that gets you more. Just like we talked about, direct indexing in an ETF is great, which I do. I have several accounts that I direct index in, but the minimum's 100,000. So for a lot of people, that's not attainable. I totally understand it. By the way, stick around for just a minute and I'll show you what the barrier to entry is for Frec. You'll see here, they talk about next level investing. You can see just for a minute, they walk you through, which I think is great. You're looking at an ETF like SPY and it tracks the S&P 500. You own individual stocks. Well, when one loses, you want to sell that out and tax loss the difference, which they talk about. You can swap it for a different one while still staying tracked on the index, and it can go towards a deduction in your tax bill. That all makes sense, but a lot of times, again, the barrier to entry is high or you manually have to do it. So Frec, they market themselves in a couple different ways. One, you can invest in the S&P 500, which is great. You get daily tax loss harvesting of individual S&P 500 stocks. You don't get that with ETFs, and a lot of robo-advisors don't do that. I've done several videos on Betterment, on Wealthfront. I'll link those down. I'll put them up here so you can look at them. They do not do daily tax loss harvesting of individual S&P 500 stocks simply because they're buying Vanguard, BlackRock, and State Street ETFs. So they're tax loss harvesting ETFs, but they're not tax loss harvesting individual stocks. That's very important. You can customize by adding or removing stocks and sectors. Most of the time, ETFs, you buy sector ETFs, whether it's consumer goods, technology, healthcare, whatever. Robo-advisors really only Wealthfront does let you optimize quite a bit and customize. Betterment doesn't really offer you any kind of customization, so that's good. Details of your trade, you can see that on all of them, so I wouldn't give that much. I wouldn't think about that too much. The big one right here off the bat is they only charge 10 basis points or 0.10 annual fee for direct indexing. That's a big one. That is a very big one because most robo-advisors charge you 0.25 or 25 basis points at a minimum to manage your money on top of what the ETFs charge you. Let's think about that for a minute. You've got the fee you're going to pay the robo-advisor. That could be 0.25, 0.4, depending on which robo-advisor. So you're at 25 to 40 basis points. From there, you go up in terms of whatever the fee on the ETF is. So the ETF could be 0.03, 0.09, 0.15. If it's an actively managed ETF, it could be 50 basis points. So you have 50 basis points and another 25. That's 75 basis points right there in just expenses before you even get into the profit or any kind of alpha. So that's a big one. That's number one. Number two, and I did tease it just a minute ago, the minimum to get in to, I think it puts it down here, minimum to invest is 20,000. That's a big one. That's another one I want you to remember is, I talked about this when I opened this video up, of the two barriers to entry. This gets rid of one of them. It takes it from $100,000 entry down to a 20,000, which is very, very big for people that, one, don't have 100,000, which sitting around in a taxable brokerage, which a lot don't. And number two, you can actually try this product without having to worry about, again, having a higher barrier to entry. Now, they do have a lot of good FAQs down here. But I'm not going to go into that. Let's jump right into what it actually looks like. So anyone can go to Frec, and then you can see what's going on in here. You can see what their platform looks like. This is all simulated. But before we do that, I really want to hammer home the Frec's unique approach. So their tech, their efficient investment strategies are key. I think they've really streamlined the process of, one, expense ratios, and barrier to entry, the minimum, and lowering the entry. But I will say, the biggest one I want you to remember is a lot of robo-advisors platforms, they do leverage tax loss harvesting while simultaneously tracking an index by swapping between similarly performing ETFs during market downturns. There's two main drawbacks of this approach when contrasted with direct indexing. I want you to pay attention here. Number one is, when you're first swapping between ETFs that are not substantially identical, often results in higher tracking error, meaning an investor may end with a substantial investment into a Russell 2000 ETF despite aiming to track the S&P 500. So that's number one. Number two is, second, because these assets generally reflect broad market performance across an entire sector, they don't allow for loss harvesting at the individual stock level. That's two. And I will say, I've been a victim of this. I've got a lot of money parked in ETFs and some with robo-advisors that I'm direct indexing at an ETF level in some, and at a certain point, now that I've got a certain amount in these funds, I am doing direct indexing at an individual level, but my expense ratio is higher and my barrier to entry is higher. Frec gets rid of both of those. It's very important. Here you can actually see your portfolio. So in this case, they put in 50,000. We're looking across the entire timeline. This goes back about 6 weeks ago, but you started with 50,000 and you're able to see the index it's tracking. If you click on this, you can actually see what the use case looks, or what the UX looks like. We've got the index. You can change the index if you want, but this is where I want you to look at. So number one, you're tracking an index, but you're holding individual stocks. So Apple, Amazon, Nvidia, Google, all these, and you're seeing the allocation percentage, you're seeing the value, and you're seeing the total return. So if I want to look up Tesla here, I can do that, and I can see that, okay, I own $404 of Tesla, but my biggest position is Apple. So I'm tracking an index, but I'm not buying an ETF. I can see I've got a little bit of cash as well. Here's where it starts to really shine. It shows you the tax losses it's harvested on a 50K portfolio in 6 weeks, 268.51, and the performance and what that looks like. Now, if I drill in here, the tax loss harvested, I can see that my short-term capital losses, my short-term capital gains, the difference. So I've had capital losses of $407, but I've gained $138. That makes my net short-term tax loss harvested $268. It's very important. If I had any long-term over a year, it would show that. And then estimated tax savings. So you can actually go in here, which I really like. You can put in your federal income tax rate. Let's say it's 25. Your federal long-term cap gains rate's 15. And let's say you have 0 state. You can do that and hit enter, and it'll show you what that looks like. And if you're unaware what those are, you just click those and it'll help you. So very intuitive. The fees you paid, like I said, they're very transparent on their fees, and their fees are much lower than what a lot of other robo-advisors are. Because again, it's not really a robo-advisor. It's just direct indexing, making sure your portfolio stays, balanced, that you're not overweight any position. But again, you're not buying ETFs. You're simply buying individual names and direct indexing and tax loss harvesting on individual names instead of an ETF. And then you can see the activity that you have. So it's gonna actually tell you, hey, on January 12th, which was a few days ago, this video is being filmed on the 15th, we're able to see that it was a short-term sell in BWA. The price was $32.68. We sold it price was $32.68. We sold it for $6.59, and we took a loss. We've taken a loss on all this so we can help draw down some of our taxable income at the end of the year with this. Now, if I move over here into the performance, you can see the same thing. Now, you can set up recurring deposits, and you can auto convert stocks into direct index. So automatically sell the stocks in your self-managed stock portfolio that are lost and invest. This is pretty interesting. You can sell stocks in a self-managed stock portfolio to automatically sell whenever there's a loss, which is greater than 3%, and invest the proceeds into direct indexing. This is pretty cool. I like this. You know, if you want to, you can transfer over from another brokerage account. I think that's very important. All right, and we've talked about that. I'm gonna link this article down here. This I want to go over just for a minute because I think it does provide a lot of interesting data. So let's actually go. I'm gonna pull this up here. Talked about the annual fee. This chart I want to go over because I think it provides a lot of great data, a lot of great info. All right, let me get this here. So if we look at, we've got three things here. We've got direct indexing, we've got ETF-based, and we've got IVV buy and hold. IVV is just an ETF for those of you who don't know, and it tracks an index. So direct indexing here, this is year one. We see that returns are a little bit higher right here. And then we've got ETF-based, so what I've talked about before, and then we've got just buying and holding an index and not doing any kind of direct indexing at all. We're just buying and holding. Year two, we see that direct indexing into those stocks versus buying into the ETF really starts to shine, almost to the point of, I think it's about 10%, and that's about 5%. So you're looking at double. But look what happens as we start to go up. As we start to go up over time, and we start to see what this looks like. If this would move. Anyways, you get the point here. As we start to go up and up, we see that once we get to here, there's so much outperformance from what direct indexing can do versus ETF-based indexing, because again, you're able to sell out of an individual name. If you own 100 stocks when you're direct indexing and only 2 or 3 go down, you can actually direct index and tax loss harvest on those individual names instead of having to sell out of an entire ETF. Here's a bonus for you. Do you think that there's more ETFs to sell out of and tax loss harvest and swap with of a comparable ETF? Or do you think there's more stocks, individual names you can tax loss harvest out of and swap? Comment down below, let me know. If you know the answer already, again, go ahead and comment, but it's something interesting and something that I don't think a lot of people are paying attention to. Okay, now this is another chart I wanted to go over with you. Is if you're wondering where capital losses, ETF-based or direct indexing can occur, here's a timeline over the last 10 years they simulated, where this line down here is ETF-based tax or direct indexing or ETF tax loss harvesting at a ETF level, and this is direct indexing at an individual level. You can see the amount of tax loss harvesting that can occur, and this is again a simulation over the last 10 years. Also, another chart I wanted to go over is if you're wondering what ETF-based, this is harvested losses as a percentage of initial deposit. This was a simulation they ran where they put one chunk of money in, no recurring deposits. If we look here, if we direct index, we've got a 38.4% return. If we do ETF-based, 20%. But if we do direct index with a 0.10 fee, which is what Frec charges you, you're only down 10 basis points, but you've automated all that. I can tell you right now, I've never met anyone that was able to effectively and efficiently tax loss harvest on their own. So paying Frec a 10 basis points is not a big deal. And ETF based, this is where a lot of robo advisors live down here. So again, if you're looking at where this might provide some value to you, direct indexing right here is where you want to look. Frec does offer you the ability to shows you what a sample statement would be at the end of the year, you know, with your portfolio, and then they're pricing their fees, you know, 0.10, 10 basis points. I don't know that I would do any kind of trading. They're charging you $20 a fee. If you're looking to trade in and out of stocks, this is not the place to do it. I would just put money in here, set it and forget it, and let it direct index. And the last thing I'll add is there's a Vanguard. I'm gonna link this article. This talks about personalized portfolio construction outside of individual tax law, or there's individual and then ETF based direct indexing. I'll leave that for you to peruse at your leisure down at the bottom. I think it's very interesting, but it talks about optimal tax loss harvesting frequency, what that looks like, when you should do it, and when you see gains. Are there more gains in the beginning? Are there more gains at the end? I think it's very interesting. And last but not least, I will link this, the simulation, the data that I went through just a minute ago. I'll link that down below. So with that being said, Are you sold on direct indexing into individual names versus ETFs? Have you heard of Frec before? If not, check them out. I'll link it down below. And don't forget to design your financial freedom. Take care. Bye-bye.